Energy went from being the best performer to the weakest performer, now off more than 3.5%, leading to the downside. Perhaps sparked here by reports that Chesapeake Energy will be filing for bankruptcy there. We're seeing shares off more than 50% today. So what does it really mean for the energy names? Want to discuss that with our next guest. Dan Eberhart is Canary LLC CEO and author of The Switch, as well as an expert in all things energy, and he joins us now. Dan, good to see you again. I mean, when we talk about this, obviously this weekend marked a very important extension of the OPEC plus supply cuts. But a lot of question marks still remain when you think about U.S. shale producers here and what oil sitting here at $40 a barrel might mean for consistent pain in the oil space. So how are you reading through all this right now as bankruptcy becomes a very real risk for a lot of these energy companies?
Yeah, so I think that OPEC extending the cuts 1 month is a whole bunch of nothing. Really doesn't get us a lot more rope to, have a market recovery. And I think it just maybe forecasts a fall in a collapse in the floor in the price of oil if when they stop extending these cuts kind of month by month. You've got to look at names like Chesapeake is kind of on the rumor mill for declaring bankruptcy. You've got Whiting and Diamond Offshore, names like that in bankruptcy, and then I think you've got especially other service companies like Neighbors, for instance, really on the precipice of Calfrac on the Canadian exchange, really running out of rope and running out of liquidity. So if we don't have a major upturn in the price of oil soon, I think you're going to see a lot of oilfield services companies declare bankruptcy, and I think you're going to see a fair amount of medium-sized E&P companies or companies with very levered balance sheets like Apache, head for bankruptcy court protection.
Yeah, and I mean, we were talking about this with Stephen Schork on the show right before we got the official word from that OPEC Plus meeting on Saturday. And he had noted that Wall Street continues to love the oil bet here, even though there are a lot of what you're discussing issues when it comes to simple supply and demand. U.S. shale producers taking about 2 million barrels out of the market. But we've still noted, I mean, we're talking about refineries still consuming about 3 to 4 fewer barrels, causing a pinch point there on the demand side. So, I mean, when we talk about all of that, considering U.S. shale producers are free, unlike OPEC and some of these other groups around the world, free to come back onto the market with oil at $40, what does that say about how this basically will persist when we move forward with production maybe coming back online here in the U.S.?
Well, I think that's kind of a good string of commentary. Look, there's two basic camps right now. There's the camp that thinks we overcut and America is opening up, demand is coming back, Brent's above 40, the export markets are fairly strong, and we're going to come out of this, and there's going to be a mini oil boom, mini supply shock near on the horizon. And then there's another camp that says, hey, look, cases are rising now for the virus in 10 states or 12 states or something. We're really looking at muted economic growth, and several sectors of the economy aren't going to come back. Oil demand right now, the IEA estimates are that demand is down about 13% from where it was last year. I think it's actually maybe down more like about 10%. I think the IEA is a lagging indicator of sorts or has a lagging data set. But, I come down on the side of optimism that we're going to power through this, but I think we really just need more visibility. We're in a fog of war right now.
Oh, as you mentioned that fog of war, I mean, it's increasingly important to focus on some of those names that may be well capitalized relative to others. I mean, you talked about the move in Chesapeake. Pretty insane to think that it was up a lot yesterday, and we think about coming back down to 50% today. Still relatively flat when you look back just about a week. So, I mean, how are you highlighting the moves in some of these names and what it says about risks that investors should be appreciating in the space right now, and where do you see maybe some of those better position names?
So if you're a medium-term investor, it's about balance sheet, and liquidity. Jamie Dimon's words, a fortress balance sheet. That's where you want to be if you want to be an energy investor in the medium or long term. If you want to play on the market highs and the energy bouncing, you want to be in these very, very levered names like a Chesapeake or Diamond Offshore, or Whiting, or maybe Apache. But again, that's a very risky place to put money right now because these balance sheets don't have a lot of room. Another downside, you're basically pricing in optimism that it's going to get better. If it stays the same, I think a lot of these types of companies are going to run out of rope really quick, particularly Chesapeake specifically, but as a sector, particularly the oilfield service sector, you're going to see an awful lot of names fall by the wayside in the next 3, 4, 5 months. if the price of oil and the rig count in the U.S. doesn't rebound strongly.
All right. Well, that's why we continue to monitor it closely. That's why we have you come back on to give us the latest. Dan Eberhart, Canary LLC CEO and author of The Switch. Appreciate you chatting with us, sir.
Thanks. Good to talk to you again, Zack.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.